Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending June 5th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This week's macro data gave us a pretty classic good news, bad news setup. On the good side, the economy still looks resilient. The ISM manufacturing PMI rose to 54 in May, its highest level since 2022. And the ISM services PMI also improved to 54.5. ADP showed private employers adding 122,000 jobs in May, and JOLTS showed job openings jumping back to 7.6 million in April. But the inflation and labor details were a little less comforting. Prices are still elevated across both manufacturing and services, supplier delivery times remain stretched, and employment components in both PMI reports were still in contraction territory, with the ISM Manufacturing Employment Index coming in at 48.6 and services employment at 47.9. So macro data has the Fed pinned in place for now, as the economy still looks resilient enough that a cut isn't warranted and inflation isn't quite hot enough to warrant a hike either. On today's episode, we'll also cover a wide range of CRE headlines, including AI spending sticker shock, underwhelming World Cup hotel demand, the Dallas Mavericks planned arena district at the former Valley View Mall site, and how the area around Madison Square Garden has transformed since the Knicks' last finals run. Then later in the episode, we'll do a 101 on REITs and plug Trepp's new REIT IQ tool. We'll also share Trepp's latest delinquency data, where the headline CMBS delinquency rate ticked up slightly to 7.55%. So Stephen, start us off with the macro picture. What stood out to you this week?
To be honest, I keep coming back to AI CapEx spend. And this question that eats away at me about, if and when we hit the apex in CapEx, that outlay is the driving force behind the current day economic strength. And there were some articles published this past week that, at least in my opinion, warrant further discussion. And we'll get into that. But first, let's walk through the economic data that sets the stage for that discussion. And Haley, you did a great job covering a lot of this, so I don't think I have to spend too much time on it, but this week's data was not exactly rate friendly. Right? The headline numbers were solid. Manufacturing, as you mentioned, it was further into expansion territory. Services improved. ADP showed a decent private payroll again. And JOLTS was surprising. That showed job openings moving higher again and is the strongest in years. And it was kind of funny, when that JOLTS data dropped, you did see rates move a little bit. And I thought, okay, maybe is this when we see the correlation between rates and economic data return to some of the historic norms? But then oil swamped all of that out, because the conflict in the Middle East is really what's been driving a lot of the rate moves recently. So the bottom line, the economic data matter, but the geopolitical tensions are still very much front and center. So the two articles that I mentioned, one of them was about an AI sticker shock that hit corporate America, and the data is amazing. I don't know if you saw this, Lonnie, but there was a company, an unnamed company, that reportedly spent $500 million in 1 month after failing to set usage limits. $500 million in 1 month. There's only so many companies in America that can do that.
Yeah, I think that's one that's probably going to be requesting a payment plan. That's a pretty significant error, and just oversight. They just didn't have limits in place. So if you ask yourself, how did this happen? When they set up their enterprise instance, they didn't put any type of cap on token usage or spend or anything else, and so the meter just kept running. And in fact, we've read a lot of these tech companies are actually measuring employee usage to the point where they want to see more tokens used. Like if you're not using some minimum number, then, that's viewed as a negative from your performance perspective. So you see, these companies, this is one of, I'm sure there's many, maybe not this much of a headline grabber, but, this cost is becoming prohibitive for a lot of firms. And this is the natural progression or natural next phase of the cycle, where you've had all of these VC subsidies on the cost of the compute. And we've talked about this at various stages of this maturing over the last couple of years, Stephen, of just at some point, one or two of these AI firms is going to become the dominant player in the market. And all of these others, due to lack of backing or lack of consumer usage and willingness to pay for the results they're getting, are going to fade out. But you're starting to see some of the cost accelerate because it's getting to that part of the cycle where the VCs want to see a return. Now, it's interesting because it's also kind of running parallel to consumer users, companies wanting to see an ROI on their usage. And so to your point, like this is kind of hitting an inflection point very quickly where we're either going to get to a win or loser type of scenario, or you're going to see some of these firms just veer off the off-ramp and say, we're going back to use something else.
Yeah, I mean, this is really a critical point in the AI adoption evolution. I guess this was maybe 18 or 24 months ago. This is the exact data I was looking for, right? I wanted signs of just how broad-based the adoption was becoming, and we now have really firm data on this. So, Lonnie, you mentioned like the performance for token usage. For our listeners out there, if you haven't heard this term, it's called token maxing. And basically, if you get an AI license to write code at my firm, I want to see you maxing out tokens. That shows me you're using the tools that we're supplying you with, and we're going to churn out more code than ever. It's going to be great. But there's been a really difficult time showing and proving that there's a hard and real ROI for that token usage. In other words, yeah, we're writing a lot of code, but I'm not seeing it translate into profits. So all I end up with is a heck of a lot of AI spend. So I'm really interested to see now how this progresses, because we should be now entering the phase where we really have that increase in efficiency and more evidence of a true ROI, because it's there. It's there. We just have to get better at using the tools.
Yeah, and this is where I'm gonna lean in even more on the benefit of AI. Right. Like I've seen a lot of stuff recently. They're just saying there's not enough utility, there's not enough ROI, there's not enough value add, there's not enough adoption. When you roll something out to your company enterprise wide, and generally the way this goes is like you get an email from the CTO or for someone in IT that says, hey, great news. Everyone now has access to Copilot. Great news. Everyone has access to ChatGPT. Everyone has access to Claude. Oh, by the way, we expect you to start using it, yesterday. You're not going to get maximum return on investment in that type of scenario. Like where this is really going to make it, it's like the 80-20 rule, but in reverse. Like 20% of your users are going to be power users, and they're going to give you 80% of your gain. It's not the 80% of people in the firm that are going to make incremental increases in their productivity that's going to move the needle. You're going to have the 4 or 5 people that really go in on this. So like, to me, I think if you look at any other type of adoption, whether it be cell phones, whether it be calculators back in the day, whatever the case may be, there's just a natural curve that occurs, and everyone is so excited about AI that the natural inclination is to like roll it out to everyone. But at this point, that waters down the value. And this really needs to be more specialized, smaller groups, more concentrated effort, more defined value additive use cases. Once those things are in play and you're seeing the ROI, then you start to expand it out to some of these broader use cases. I think at this point, it's like if you like steak dinner, you're going to get a much better steak at a fancy high-end steakhouse than you are going to a buffet that serves steak. And right now we're kind of at the buffet phase of AI where everyone gets a little bit of something. And of course it's going to disappoint in that scenario.
So you're talking like Golden Corral versus Ruth's Chris?
That's kind of what I'm saying. Like if you're going out to a fancy steak dinner at Golden Corral, you might be disappointed with the quality of the steak. It's still steak. It's still going to give you that protein bump, but it's not, the same thing as going to a nicer, higher end steakhouse. And I think for these, you mentioned it on the coding, that's a very easy one. Are your engineers producing more code, production ready code? And the answer is yes. Like that's the part that I think gets glossed over. Like if you look at some of these more technical use cases, it's very difficult to argue with the productivity gains and the value add that AI is creating on the coding side. Like that's a very one-to-one type of use case. It's for other people that are used to being in relationship type businesses like CRE. You're used to sitting down with someone at lunch and getting business through referrals and word of mouth, and trying to automate a system that does some of that for you is foreign to people. And so their first couple attempts at that are going to be less productive than what you would expect. And it's a natural evolution. But I'm I'm still very bullish. I do think you're going to see pullback at the corporate level for the reasons we've just outlined. But I think that'll be, I think it's just part of the equation that has to happen. Like it's just like anything else. It used to be like when people had mobile Wi-Fi hotspots. You didn't roll those out to everyone in the company. The people that traveled and needed to be connected, they got them. And then it got to a point where everyone had a hotspot on your cell phone. And so now everyone has one, but it wasn't like that immediately.
Right. One of the things that I love this Axios article mentioned, because it's hilarious to me, is that, when you have that CTO message to the company, hey, everybody start using AI, and people don't know how to use AI, inevitably it's going to be inefficient AI usage. So one of the specific use cases was, he said, yeah, we found out that some employees were using AI to just check the weather. Oh, that's fantastic.
Well, if you have a lunch program, I'm sure we've had some people at Trepp even that like run their lunch options through AI and have them make like a lunch calendar for them. Like, okay, great. Maybe it saves them a few minutes a day, but that's not a value add for the firm.
No. And so what I worry about here, to connect the dots to the next article, is if the corporate pullback becomes more severe, right? The first order change on CapEx spend is massive. Right? It's steeper than 45 degrees. What I worry about is that second order, right? The deceleration in CapEx that might be justified depending on the level of corporate pullback or the level of corporate budgeting we start to see. And specifically why that worries me is we just had this Wall Street Journal article drop this week saying that America's data center build-out is falling way behind schedule. A JP Morgan analysis found that more than 60% of data center capacity planned for completion in 2027 is not yet even under construction, and another 7% is delayed. So these bottlenecks are just massively costly, and they're coming from power, permitting, equipment, grid interconnection. We've talked through so many of these issues on both the pod at Trepp Connect and in other settings. And so it's going to be interesting to see, exactly how this bottleneck kind of plays out. And if the construction delay stretches out further, because the CapEx spend numbers that I've heard, like in the $4 trillion range from the top hyperscalers going through 2030, I start to wonder, does this get pushed out to 2035, 2037? And if we're spreading that CapEx over a longer time period, what kind of economic implications does that have? Especially if, heaven forbid, the R word comes up, recession, right? There's a lot of things that can happen between now and completion. And so that second order change, the deceleration in CapEx, could become more severe if we start seeing this negative feedback cycle between corporate pullback in CapEx spends combined with construction delay means less economic output.
Yes. I mean, I think those second order effects are potentially more indicative of like a real stress scenario. And on the data center construction side, Stephen, like welcome to real estate development. I mean, this is just how it goes. I mean, go talk to someone in LA that's trying to build housing. Go talk to someone across the country that's trying to build whatever it is they're trying to build. And it's bureaucratic. I mean, that's why I say every time I fly into New York City and I look out the window, like we could not replicate Manhattan again if we started over today because of all the red tape and the bureaucracy that's attached to it. And I think with the data centers, maybe it's a little bit less bureaucratic, even though like now with the local pushback that you're getting in a lot of markets, it's becoming that way. But there's just real, challenging components of taking something from raw land and turning it into something else. No matter how much money you spend, the underlying requirements to build something don't change. I mean, you got to get permitting, you have to have power, and then you increase the requirements for some of these sites, and it's just that much of a magnitude shift where it's even more difficult. So I think that we'll kind of hit an equilibrium here where it needs to be. I mean, I think if we were being honest, all of the spending is probably too much, for the reasons that we talked about on the intro here. I mean, there's just not enough value add at this point to maybe justify all of the spend today. But if you look forward and you think that AI is going to do what we think AI is going to do, we're probably going to be underdeveloped in some of these markets in the next couple of, to call it 10 years or so. So there's more to come on this. As we were talking about the CTO rollout of AI, I did want to give a little bit of a plug to some of the stuff we're doing at Trepp, because we've released our MCP servers. We've talked about them some on the podcast, but this show is not a commercial for our products directly, but we'd be missing an opportunity here just to talk about how you can have these client-facing connectors like our Trepp MCP that allows people to work in their cloud instance directly access Trepp data through prompting and create some really robust analytics and insights that they could not do on their own. And it even takes people that are already Trepp clients that have traditionally accessed our data through our front-end web application and allows them to interact with the data real time through prompting. And you can create skills in Claude that generate underwriting reports or property level reports or whatever your firm does that's like your secret sauce. You can effectively build those skills out in Claude using the Trepp data and the MCP to turbocharge your output. So, for people that listen to the show and hear us kind of, today bemoan a little bit some of this, lack of ROI, we can tell you firsthand from our perspective at Trepp, there are very definitive, immediately additive use cases for AI. One of those would be the Trepp MCP.
Yes, very much so. Like, we're not checking the weather here. We're saying you can plug an address into your chatbot. Because it's plugged into this MCP, it just turbocharges your output. And what you get is transformative. It's mind-blowing. It's unbelievable what you can do with the Trepp MCP.
If you haven't seen what we're doing, we're going to put a couple of webinars together because we know for a lot of people, MCP is just another acronym. It doesn't really mean anything to them. They haven't seen what it is. They just hear people like us talking about it, and it's like AI, MCP, API, who knows what else. So we're going to try to put some educational segments together that just give people a foundational understanding of, what is an MCP and what does it mean for you as an end user of tools, and how does it increase productivity and add value? Because we think if people can get a better understanding of that, then to your point, Stephen, like when you see these things in action, it's undeniable. I mean, it's literally replaces what would take an analyst a day or 2 or 3 in certain instances and produces the exact same level of quality output, if not better, in a matter of minutes or seconds. I mean, it is. And since our MCP is just connected to our data, there's no hallucinations. There's no, all of that stuff that you get with some of these just, broad brush LLMs that are scraping the web. You don't have to worry about that when it's plugged in directly to a reliable, trusted, data set.
Exactly. There's no data hallucinations here because the data is Trepp data and it's trusted data.
Podcast@trepp.com if you want more info, or if you will be at the CREFC conference in New York City next week. We will be on the ground walking people through this in person, so we'd love to meet with you or invite you to our office. We have a beautiful office in Midtown Manhattan, and we'd love to have you here to show you what we're building. So let's get into some of our main stories of the week. As we mentioned in the intro, there's been a theme that's come up in the news this week, and that's the growing overlap between sports, cities, and commercial real estate. So whether it's the World Cup, new arena developments in Dallas, or even how Midtown Manhattan has changed since the last time the Knicks were this far in the series, these stories all get at the broader economic impact that sports can have on cities and real estate. So let's start with the World Cup hotel story. We saw an article in the New York Times that hotels in the U.S. World Cup host cities are claiming underwhelming demand.
Yeah, this is a really good article by the Times and specifically The Athletic. So the hotels that were in the host cities for the 2026 World Cup, as you mentioned, Haley, they're reporting weaker than expected booking demand. And the survey data cited in the article said that nearly 80% of the hotel respondents said that bookings are tracking below initial forecasts for the June 11th through July 19th tournament. And the softness is widespread across markets. More than 70% of respondents in San Francisco, Seattle, Philadelphia, and Boston said booking pace was below expectations. We had similar concerns in Los Angeles, New York, Houston, and Dallas. And really, it's Miami and Atlanta looked relatively stronger, but still mixed. So the concern is that the World Cup is not going to deliver the economic lift that FIFA had promised. I think a quote I heard was something like 30 billion of economic impact, something like that. But there's a little bit of a funny way that these hotel bookings work. Basically, FIFA would go in and they would book up some large room blocks well ahead of time, but they have options to cancel some of those room blocks. Basically, we need to get the teams, coaches, and all of the staff and people to the cities where we need them, when we need them. But we might have to shift things around depending on how the schedules play out. And so a lot of rooms were tied up really early in the booking process. And so that inflated hotel prices and put a lot of folks off from booking. So now that the cancellations have come through, the hotels are saying, hey, wait a second. If you're not going to be booking these room nights, I all of a sudden have to scramble and backfill. And that's been really painful for some of these hotel operators. So it's going to be interesting to see. We're still, I would say, kind of in that last mile stretch where some of the hotels may be able to still capture some of that room revenue, but those late in the process cancellations really, really threw a wrench in some of those revenue forecast expectations.
Yeah, I mean, this is just the challenge of forecasting what something's going to have from an economic impact perspective when you have macro geopolitical tensions that arise without, notice. And we've had a lot of things happening in the U.S. that have made some of that international travel maybe pull back some. The people are going to feel that most directly are the hotels. I mean, the one thing that we've seen through COVID and post-COVID and now with the World Cup is just hotels by definition are night-to-night business. And to your point, Stephen, I mean, people will book and then cancel. And hotels have a fine line between prepay requirements and, allowing people to back out of commitments within like 2 or 3 days of their stay starting. So, we'll see what happens with this. I think the FIFA hasn't helped itself. I mean, the way they did the ticket rollout, effectively the first lottery that they had set up allowed people to feel like they were going to get the best seats with the first version of the ticket rollout. And then little did they know they've had 2 or 3 subsequent lottery rollouts that actually were the better tickets. So you had this first group that thought they hit a home run, only to find out that their tickets are in section 300, and the people that were in the second or third tier of the lottery selection got the ground or field level seats. And so everything about this just feels a little bit squishy. And of course, that's going to have negative ramifications for those second order effects like we talked about on the AI stuff. In this case, it just happens to be hotels.
Yeah, the economic models tell us how to optimize revenue in a lottery or an auction process, but sometimes those optimal economic models don't always translate the same way we think they're going to, especially given some of the just negative public perception of, say, like Ticketmaster, right? And the Taylor Swift debacle. I mean, people have really been turned off of some of these processes that, yeah, they can maximize revenue, but I don't even participate because I'm turned off the process. Now, speaking of sports, we have another big one here. Dallas Mavericks are purchasing Valley View Mall for their new arena. Thoughts, Lonnie?
Yeah, so I mean, I think this is a record. It's like 3 weeks in a row where we've had like some very specific downtown Dallas type of dialogue. And the news hasn't been great for the folks in downtown because there's like a mass exodus, even though the overarching narrative for Dallas is still overwhelmingly positive. And yeah, so this is an interesting, and I have a little bit of a personal history here with this site. So I'm going to take you guys back. But in 2013, when I was in grad school, we did a case study competition with NAIOP, NAIOP, and the piece of property that was selected for our case study was the Valley View Mall site. And it was being acquired by a company called Beck Ventures, which was owned by Scott Beck. And they wanted us as grad students to come up with a redevelopment plan for that site. So we had 7 days to take the case study and turn it into an output, which, that's typically how case studies go. So our team won. That was great. I was the team captain. So that was a nice little way to finish out grad school. But here we are, 2026, and that site is effectively still looking for some flagship anchor. They've had so much legal. I mean, for those that don't know, Valley View Mall was a very prominent mall in its heyday. The neighborhood demographic shifted over time. People stopped coming to the mall. It went into disrepair. It was purchased, as I mentioned, by Beck Ventures to effectively tear the mall down and build a mixed-use development. They called it Dallas Midtown is what they were going to reposition it as. The city of Dallas actually offered a bunch of incentives. At one point, they had over $20 million worth of incentives tied to the redevelopment here, but it required that they demolish a certain percentage of the mall to be eligible, and they still had 2 or 3 lingering mall tenants that when they started tearing the mall down, there were commingled electrical lines and plumbing, so they couldn't tear the parts down that had to be torn down without negatively impacting the existing tenants. So they had to stop, and the city abatements and incentives expired. And then there was a bunch of lawsuits and all this stuff. So flash forward to this week. All right, let's get to this stuff. I'm done waxing poetic about my glory days in grad school. And so now the Dallas Mavericks have said the American Airlines Center is no longer nice enough for them, even though they built a mass transit. Trinity Railway Express actually drops you off at the venue. So there's actually mass transit in Texas to this arena, which is not common. They said they don't want to stay there anymore. The Dallas Stars also said they don't want to stay there anymore. They shared it. And so they're going to, potentially move to this Valley View Center site, which is great. It's a nice interconnection of multiple highways. It's kind of a greenfield development in the sense that they're going to be able to do whatever they want. I think they're going to build an entertainment district. They're going to make it really nice, but it's got city council. It's got a bunch of other folks in Dallas, prominent people mixed on if this is a good deal or a bad deal. We were talking before the show, this is not uncommon in today's day and age. I mean, the Chicago Bears have been plenty of reports that they're going to be moving to Indiana for their new stadium because they can't seem to get alignment with the politicians and how to get that structured. So we'll see what happens here. I think this is anything but a done deal. This is actually on Preston Road in Dallas. It's, over 400 acres in total. I think the portion they're looking at is about 104 acres. We'll see if this actually comes to fruition. I'm supportive of it. I think it would be cool, but it certainly will leave another hole in that downtown Dallas market.
Well, and that wasn't the only team to announce, right, Lonnie?
Yeah, the Dallas Stars also. They share the American Airlines Center now, and they're going to move to Plano. So I mean, it's like everything moves to Plano. Plano, that North Dallas market is on fire right now. They plan to build a $1 billion arena there. So that's another interesting situation in the sense that for the last however long, 20 plus years, the Stars and the Mavericks have kind of been synonymous because they've played in the same place. Now they have two of their own freestanding venues. And I think it just highlights some of these sporting events venues really wanting to be embedded in these entertainment districts. And it's not new. If you go to Boston, where Fenway Park is, I mean, part of the allure is that you have all of the restaurants and bars and everything right outside the stadium. If you go to Wrigley Field, you have Wrigleyville right there, or you can go eat, drink, spend all day outside the stadium and then go watch the game. And I think for some of these newer developments, they're trying to recreate that in a modern, mixed use type of format.
Yeah, I want to say Plano's been on the map for like 30 years now.
Yeah, I mean, Plano was a very affluent community when it was first founded and has remained that way. Now you have Frisco and some of these like newer developments that are, challenging. Like Plano at this point might be considered more of the old money. But yeah, it's seen a resurgence over the last couple of years. They have really great retail. They have strong, from a CRE perspective, the demographics are great. I mean, you have disposable income, you have highly educated folks. And so all the national credit retailers want to be there. And they've done a great job of kind of mixing, new development that appeals to people in today's kind of, mixed use, live, work, play type of environment. And I know we've been kind of going off on this for a while, but I think there's a question to be asked, like, is there a residual value to having a sports team in your community? Like, that's the part where I struggle at some level, because if you look at the Dallas Cowboys Stadium as an example, they effectively use condemnation, eminent domain to do a public taking to build the stadium, which displaced a whole, large number of residents. Now, leading up to that, Jerry Jones formed about 25 shell companies and bought up all the houses before they announced it, and then was able to get repaid plus with the eminent domain just compensation, a whole interesting case study. But, usually the taxpayers fund a majority of the cost of these builds, and you get the sales tax revenue and you get like the foot traffic and other things. But I just don't know for like the Mavericks that play, 82 games in a season, 41 of them at home, do you get an ROI from a community perspective of like putting yourself out there and having the team?
I'm just going to venture a guess here. I'm going to say at best case, if it's only the sports team operating out of there, at best case, it's a wash. Where you see the positive is when you can repurpose the arena for a massive number of other events, conventions, you name it, right? The more stuff that you can get done in that same space outside of sports, the more profitable it's going to be.
And you've seen that with Jerry Jones. There are concerts, they have monster trucks, they have, dirt bikes, they have all kinds of stuff, WWE, college football playoffs, all those things that really, and in that instance, to your point, it does provide a lot of employment for people that actually serve food and do things there. But it's a celebratory week for the folks in Plano and at the Valley View Mall site. My question just is, in 10 years, or 20 years, are they going to be sitting holding the bag similar to the folks that were all gung-ho for building the American Airlines Center, and then now they're walking away from it?
Well, Hopefully we'll still be running TreppWire by then, be able to come full circle. All right, so speaking of moves, we had a corporate move announced this week. Samsung is moving their U.S. headquarters from New Jersey to Texas. And this is wild because Samsung hasn't been in New Jersey all that long. So specifically, Samsung is moving from Inglewood Cliffs to Texas, and that relocation is expected to be completed by the end of 2026. Company saying that move supports long-term growth, operational alignment. I mean, for a whole host of reasons. It's been very, very costly for Samsung to operate in New Jersey, more so, I think, than they had projected. And, well, given the favorable tax environments in Texas, it seems like a no-brainer. So can you guess the market where Samsung is moving to, Lonnie? Strong hint.
I would
What
say,
we just got done talking about.
If I had to take a guess, maybe go in Plano, Texas here.
There you go.
They've also had huge. I mean, they just built their chip fabrication plants in Taylor, which is just outside of Austin. That site has over 5 million square meters and about 40 billion invested in Texas since 1996. The two Austin fabs have 18 billion just on their own. And so it's, not surprising. The timing is surprising because I think that, like you said, they were in Jersey for like 7 months or something. I mean, it was like super short lived. But that's another one that we would call a mixed green where, I mean, who's going to backfill that space in Jersey? I mean, is there really going to be someone that comes in and takes that space down? And I think this is indicative of just leadership saying, we're going to eat the sunken cost on some of these developments and move to the tax-friendly states where they want us to be there long term. But I wanted to highlight real quick on this Samsung story, the economic impact, because we were talking about the economic impact of FIFA and the World Cup and how it's been a little disappointing. But chew on this real quick. In 2024 alone, Samsung's Texas campuses generated $19.8 billion for the Central Texas economy, supported 38,500 jobs, $2.6 billion in worker salaries. That's 4,900 direct jobs and 11,291 indirect jobs in Austin. Even if you have disappointing news around, say, the World Cup as an example, these corporate relocations, and much more permanent than these sporting events, these corporate relocations can be a huge economic boon for some of these markets.
It's the gift that keeps on giving.
Okay, so let's go back to sports and back to New York here. Everyone in New York, and I think across the country, are talking about the Knicks. We found an interesting article in by Traded Media that uses the Knicks' first NBA Finals run since 1999 as a hook to show how dramatically the area around Madison Square Garden has changed. So let's run through this article and talk about real estate in the Madison Square Garden area.
Yeah, I love pieces like this. Articles like this are so fun because it brings some nostalgia, it brings some, teaching lessons, and ties it into something that we all can relate to. Even if you're not a basketball fan, chances are you've seen the Knicks in the news. It's wild. In 1999, MSG sat in an aging, transit-heavy Midtown West corridor defined by a deteriorating Penn Station, older office stock, and limited institutional real estate investment. Since then, it's 180 degrees different. Midtown West has become one of Manhattan's biggest redevelopment stories. Hudson Yards, Moynihan Train Hall, Renado's Penn District strategy, office repositionings, and new hospitality mixed-use projects have helped shift the neighborhood from a commuter corridor into a major office, infrastructure, and investment district. Madison Square Garden is now at the center of a high-stakes real estate and infrastructure debate. The article notes roughly 1.4 million square feet of unused air rights tied to the district and redevelopment potential approaching 3.7 million square feet, making the MSG/Penn Station area one of the most politically contested development sites in New York. Penn Station redevelopment remains the key catalyst. Federal officials are moving forward with an estimated $8 billion overhaul that would improve concourses, entrances, pedestrian flow, retail integration, ceiling heights, natural light, and broader public infrastructure while keeping MSG in place for now. The Knicks' playoff run is creating near-term economic momentum around MSG. And the article points to stronger restaurant and bar demand, increased Midtown hotel activity, rising transit traffic, surging ticket prices, and renewed investor attention on the Penn District. So basically the takeaway here, the sports story, is really a serious story. MSG has gone from sitting above a struggling transit hub to anchoring one of Manhattan's most valuable redevelopment zones, where sports, infrastructure, office repositioning, air rights, and public sector politics all intersect.
You want to know, we've talked a lot about inflation. We've just talked a lot about some of the new development. What do you want to take a guess at some of these inflation of ticket prices from the last time the Knicks were in the NBA Finals back in 1999? How much do you think in 1999 NBA Finals ticket at MSG, what was the average cost, maybe for floor seats and then nosebleed?
Average cost for floor? I'm going to guess like $2,500.
So 43.50 for floor seats back in 99. Now, what about nosebleed back in 99?
Nosebleed, I'm thinking $25.
You're pretty good, $50.
Okay.
Okay, let's fast forward to now, 2026. Okay. What do you think games 3, 4, and 6 in MSG? What is the average price for courtside seats? And then we'll do the same thing for like the highest floor nosebleed seats.
All right, we're going to keep this fair. Are we talking face value? Or are we talking resale?
I'm talking about market. We're talking market value. Like what you got to pay to get in. What you got to pay to get in.
Oh, man. Average, I'm thinking, especially if we're talking resale in here, not face value, resale. I'm thinking probably like 25. No. 100 grand for floor seats.
So depending on where you look, it says some of them say average. StubHub, as an example, says 65,000. But there's been confirmed that 2 courtside seats sold for 279,000. So 140,000 basically per seat. So we've gone from 4,300 to effectively, somewhere between, call it 65 and 140,000 a seat. Now for the nosebleeds, we're at $50 back in the day. I'll just give you the answer on this one. You're basically looking at 5,500 for nosebleeds.
5,500.
So then on game 6 right now, you can buy game 6 highest floor seats start at $5,400, something like that in nosebleeds.
I mean, what kind of an experience am I getting? I'm watching on TV.
This is the conundrum, right? Like, let's just say that you're a lifelong Knicks fan. It's been 27 years since they've been to the finals. You may have lived your entire adult life rooting for the Knicks. They finally make the finals. I think there's a lot of people that are ponying up the $5,400 or $5,200, whatever the number is, to go, just because they've spent their entire life like rooting for a team that's not gotten there. But I'm with you. Like I'm not spending that money.
No, I mean for just 2 tickets, 10 grand. I'm rebuilding my back deck, man.
What about you, Haley? Are you in at 5,200?
I'll go to the bar and watch it there. All right. So over the past few weeks, we've been talking about different apartment REITs and mergers of these apartment REITs, but we wanted to take a step back today and do a 101 segment on REITs, which, if you're not familiar, a REIT stands for a real estate investment trust. And the simplest way to think about it is this. A REIT is a company that owns, operates, or finances income-producing real estate. So, Professor Bushbaum, walk us through this lesson on REITs and some of the historical context.
So, a little bit of the history here first, because I think this helps explain why REITs exist. That the big policy idea behind REITs was to democratize access to income-producing real estate, right? Like any of us commoners can't really get in on Manhattan office towers. I might want that in my retirement portfolio, but I personally will never stand a chance in being able to invest in trophy real estate. So that was really the big idea. Congress created the REIT structure in 1960. The legislation was signed by President Eisenhower, and the model has since become a major part of U.S. commercial real estate capital markets, and honestly, broader just investment in capital markets. The first REITs included Bradley Real Estate Investors, Continental Mortgage Investors, First Mortgage Investors, First Union Real Estate, Pennsylvania Real Estate Investment Trust, and Washington Real Estate Investment Trust. So I figured I'd just give a little bit of the history here so we can see the evolution of the REIT sector. The REIT structure was created in 1960, but the industry as we know it today really came together in stages. The 1976 tax changes made REITs easier to structure as corporations. The 1986 Tax Reform Act was a major inflection point because it allowed REITs to be internally managed, making them look much more like real operating companies. Then the early 90s kicked off the modern REIT era with Kimco's IPO, the first UPREIT structure from Taubman, and changes that made it easier for pension capital to invest. After that, the 1999 REIT Modernization Act gave REITs more flexibility through taxable REIT subsidiaries and reduced the distribution requirement back to 90%. So since the 2000s and 2010s, REITs increasingly became mainstream. REIT ETFs were launched. REITs, and this is a huge one, REITs entered the S&P 500. The industry recapitalized after the financial crisis, and foreign investment rules improved. And importantly, this is an important date here, and in 2016, real estate became its own GICS sector. So basically, REITs were carved out as one of the major investment sectors, which is really important for kind of benchmarking, transparency, and reporting. So that 2016 date is interesting because if you go back to, say, the early 2000s and look at institutional ownership in REITs, it might have been like, say, 25%. Post 2016, we're talking like 95% institutional ownership in these companies. So it went from being kind of more of a common retail investment product to heavily institutional driven. Now, Lonnie, when REITs come to mind, what's one of the key things that you think of with a REIT?
The 90% rule.
There you go. 90% of its taxable income has to be distributed to shareholders. That's why REITs are often viewed as income-oriented investments. REITs have to pass through that income to shareholders rather than retain it at the corporate level. And so REITs look really good as a dividend tool. So in return for distributing all of that taxable income to shareholders, REITs get a tax break, right? So some other important qualification rules: at least 75% of a REIT's assets generally have to be real estate assets, cash, or government securities. At least 75% of its gross income has to come from real estate related sources like rents from real property or interest on mortgages secured by real property. It also needs to be widely held with at least 100 shareholders, and also has to satisfy the 550 rule. No more than 5 individuals can hold more than 50% of a REIT. Most of our listeners are probably familiar with the various flavors of REITs. You have equity REITs, mortgage REITs, hybrid REITs. Again, probably most of our listeners are familiar with the public versus private. Most of the REITs that might come to mind are publicly traded, but you also have public non-listed REITs that are not listed on an exchange. And then finally, you also have private REITs that are not traded on an exchange and are generally exempt from SEC registration. 2 final things I just wanted to mention. One is the UPREIT structure. Maybe some of our younger listeners haven't heard this term before. It stands for Umbrella Partnership Real Estate Investment Trust. In an UPREIT structure, property owners can contribute real estate into an operating partnership controlled by the REIT. And instead of selling the property for cash, the contributor receives operating partnership units, also called OP units. Those units can typically be converted into REIT shares or cash later on. So you might sometimes hear that UPREIT referred to as a 721 exchange. The reason that structure is so important is it's a tax deferral. If the owner sells the property and just sells it outright, that may trigger a big taxable gain today. But instead, you can contribute that property into a partnership in exchange for those units and defer the gain. So that UPREIT structure is a very tax-savvy way to roll the assets into a larger public or institutional platform without triggering an immediate tax event. There's also a down REIT structure. This is far, far less common, but ideas kind of similar. The big difference between an UPREIT and a down REIT structure is that with a down REIT structure, you're not gaining exposure to the whole REIT umbrella. It's really limited to your specific operating partnership shares, and it does give you more control over the operation and management of that real estate that you contributed. But down REIT transactions are exponentially more complex. So we really don't have time to get into that on the show today. But the reason why I want to bring all of this up is recently Trepp rolled out what we call the REIT IQ tool, which is a pretty fun tool. Lonnie, you want to give us a little bit of insight into what this tool provides our users?
Yeah, I mean, so as you mentioned, Stephen, I mean, the REITs have become a major player in the commercial real estate landscape. And as such, with their public disclosures and requirements that the SEC compels them to produce, there's a lot of really great insights put out by them, whether it be on their earnings calls or in their 10Q or 10K or 8K filings. So what we've done with our REIT IQ tool is effectively comb through all of the earnings calls to include, analyst questions, et cetera, and turn that into some key insights. So allows you to not spend the time listening to the calls themselves, but leverage some of our tooling that gives you, key market trends, management strategies, strategic shifts, and overall market and sector sentiment, in a very quick and easily digestible format.
So let me just give you a little bit of a sense of what kind of insights you can generate with this tool. First, let's start with the 50,000 foot level that we derived here. Nearly 60% of REITs increased FFO projections for 2026. Just another sign that CRE fundamentals are improving, with the best performers being mall, hotel, and data center owners. And on the negative side, apartments and self-storage. So those have been the sectors that have been most pressured by supply. So on the whole, first quarter 2026 REIT earnings were solid, with more than half of REITs increasing their guidance. But let's zoom into some of the specific sectors and see what kind of takeaways we got. So let's start with retail. Retail real estate fundamentals remain exceptionally strong, with new supply at historic lows, 0.2%, creating significant scarcity of high-quality commercial space and driving up robust tenant demand across grocery-anchored, convenience, and necessity-based retail sectors. Capital markets dynamics show cap rate stability despite treasury volatility, with institutional capital flowing into open-air retail at the highest pace in decades, and potential compression is expected in the second quarter across asset categories. I don't have time to go through all of the insights from this tool, so keep in mind, I'm just giving you a taste of some of the insights that this tool is providing, and we're only doing it at the sector level. This tool works at the individual REIT level as well, so some of the most valuable insights you'll be getting are likely going to come from the individual company analytics or the individual company analyses.
Yeah, and just quickly, we're going to actually have a guest podcast coming up, I believe, with Justin Stein, Tanger, which is the Tanger Factory Outlet Centers is what they're probably most known for over time. But they're a publicly traded REIT under the New York Stock Exchange, ticker SKT. And so we'll be able to do a deep dive, and he can definitely walk us through how some of the regulatory compliance and everything comes into play when you're an executive at a REIT, what you can say, what you can't say, what has to be disclosed, et cetera, et cetera. So I know the last couple of weeks we've had some pretty cool deep dive analysis on REITs, but there's more to come here. It's good because it's such a huge component of the marketplace. And so you do a great job with those, Stephen. Thank you for just walking us through at a granular enough level. If you want to talk to Stephen or you want to talk to one of us about REITs in more granularity, you can email us. We'll be happy to jump on a call and kind of walk you through it, especially the up REIT and down REIT stuff. We can nerd out on some of that stuff.
Okay, so I'll give some programming notes for the day. At the start of every month, we always release our Trepp delinquency report. So you can find that report on our website or our LinkedIn or our Twitter page, or reach out to us at podcast@trepp.com. The May report found that the rate is now up to 7.55%. And the 5 largest newly delinquent loans accounted for $1.86 billion of the $4.04 billion in newly delinquent loans. So if you want to see a property type breakdown and more of the findings, reach out to us and we will send you that report. At the start of every month, we also are now sharing a hard maturities report. Hard maturities represent loans with no remaining contractual extension options. And in June 2026, we reported that the hard maturity cohort totals $2.57 billion across 97 loan pieces, comprising 78 whole loans. If you're interested in that report or any of our other monthly analyses, reach out to us at podcast@trepp.com. And as a reminder, you still can catch us at the Global ABS Conference if you will be in Barcelona during the week of June 9th through 11th. Our structured team will be there talking all things CMBS and CLOs. We'll be at booth F10. And if you're a pod listener, please go up to our team there and let us know that you're a listener. We love to have people from across the globe tell us that they've met us at a conference. We'll also be at the CREFC June conference from June 8th through 10th in New York City. So reach out to us. We still have a few slots left on our calendar, and we'd love to find time to meet with you. We have some very cool meetings lined up with potential podcast guests who will be joining us on future episodes. So we're excited to share those names with our listeners as well. And turning to shout outs, Tyler F. said he's really enjoyed the latest episodes. The last one breaking down how to get the implied cap rate on the Avalon Bay deal was really cool. I love how you're getting into the weeds where we live every day. Tyler asked you to get lunch, Lonnie, so I think you guys are meeting up this week because he's in the Fort Worth area. So we're really excited to meet you in person, Tyler, and get to chat about your investment group that you lead and everything you're doing in the commercial real estate industry as well. Will S. thanked us for putting the show together. He said it's the part of the week that he looks forward to. Same with us, Will, so thank you. Troy L. was interested in joining our monthly webinar series. We haven't sent out our invites for our next Market Pulse webinar yet, but if you reach out to us, we can make sure that you're on the list to get that. Azad H. gave us a shout out for our latest lodging report. And he said the lodging sector is a good example of where the next cycle will not treat all assets equally. Some hotel assets are not just facing a temporary market challenge, but a deeper question around guest relevance, CapEx, brand positioning, and operating efficiency. And he shared some other details about some of the markets he's tracking. So thank you for those details. And if you haven't seen our latest lodging report that Stephen and team worked on, reach out to us and we'll get you a copy of that. Tabor G just listened to our last episode and was interested in getting the retail graphs and insights that we shared. Tammy P is a big fan of the pod and has been listening since the very beginning. Mark E was interested in having us come present at an upcoming conference they're hosting in California. So we will reach out to you and make sure we can get that on the books. Our good friend, Dr. Debt Yield, John B, really enjoyed our Avalon Bay discussion as well. He said, fantastic analysis by Stephen, and had some interesting commentary here. Anything you want to share from Dr. Debt Yield's thoughts, Stephen?
Oh, I love this email. So believe me, Dr. Debt Yield, I was debating if I wanted to do this in the podcast or an email, but I feel like talking through it is way more fun in the podcast. So Dr. Debt Yield made an excellent point here. He said if the stock market is valuing the assets at a 6-ish cap rate, but the private market is like 4.5 to low 5s, why not sell to a private mega fund like Blackstone at a 5 cap? That would clearly be maximizing value for shareholders. And I 100% agree. I look at that, private market to equity valuation gap, and I think the same thing. But what Dr. Debt Yield honed in on is like, well, if you do that, you're out of a job, right? I mean, yes, you could maximize for shareholders, but I also have very strong self-preservation as well. And, probably am viewing this wide private to public valuation gap as perhaps a temporary disconnect, but also an opportune time to merge and create synergies and mega enterprise value with a merger of this sort. So I feel like this was a very opportune merger point. And one of the other fun things that Dr. Debt Yield highlighted was one of the trends he was seeing in 5 versus 10-year money, that the 5-year term spreads were, kind of wider. Right. So this is something we'll have to follow up on because this is a topic that I intend to nerd out on significantly here in the coming future. So more to come on the term premium for CRE loans here for you, Dr. Debt Yield.
And Michael C shared our lodging recovery report. Micah B thanked Lonnie for joining the CBRE event a few weeks ago. Cedric F was interested in the retail charts that we mentioned on episode 397. And Brian B was listening closely and heard us talking about the 20 times square loan and asked us about the size of the balloon payment. So if you're ever listening to us chat through a story and you're wondering if we have any more details, reach out to us because we likely do. We have a lot of data here at Trepp. So thank you to everyone for reaching out. We're excited to see so many of you at the CREFC conference next week. And guys, we're almost at 400 episodes. So stay tuned, listeners. We will have some buzz around our 400th episode. As always, we appreciate all of you for tuning in every week. We've seen a lot of new listeners joining us. We've had a big spike in listens over the past few weeks. We thank you and ask that you continue sharing this podcast with your friends, your colleagues, your new interns that you might have for the summer, and rate us on Apple or Spotify if you haven't already. With that, we'll close. Thanks to our producer, Mariana Sabrana. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.